Welcome to Chapter 9. A general guide, part of Practical Bookkeeping Theory. Brought to you by the Association of Practical Accounts. APA. Hi, my name is Kate, together with Paul, to take you through this chapter. We only appear on this slide, but we'll be talking to you through the whole chapter. To get the best from us, we request for silence and maximum attention. However, if there is anything not clear, please pause or replay the video as many times as you want. We wish you all a good learning session. Chapter Overview. 9.1. Double entry is on slide 5. 9.2. Narration is on slide 16. 9.3. Duplication is on slide 23. 9.4. Supporting documents is on slide 28. 9.5. Single accounts is on slide 36. 9.6. Account numbering is on slide 45. 9.7. Errors not acceptable is on slide 47. 9.8. Completion marking is on slide 56. 9.9. What is recorded is on slide 60. 9.10. Document recording process is on slide 63. 9.11. Verifying records is on slide 77. 9.12. Vertical accounts is on slide 81.
Section 9.1. Double entry. In this chapter we'll look at general principles to follow when recording. It's a requirement in bookkeeping that all values are recorded twice, once on a source account and once on a destination account. The source account is credited by recording in the credit column, while the destination account is debited by recording in the debit column. We credit the giving account and debit the receiving account. This recording process is like moving values from one account to another. For example, when the owner invests $10,000 cash in a business, their personal capital account, which gave the money, is credited by recording in the credit column, while the cash account, which received the money, is debited by recording in the debit column. The double entry is illustrated below. When stock is bought using $700 cash, we credit the source account, which is cash, and debit the destination account, which is stock purchases, as illustrated below. This slide shows the cash account credited with $700, while the stock purchases account is debited with $700. When the value has been recorded in the credit column and the debit column, then double entry has been satisfied. An entry is a recording onto an account that comprises of a date, a narration, the source document's reference number, and the amount in either the debit or credit column. Using vertical accounts, a balance is computed after each entry, in the last column on the right.
The stock purchases account receives the value whenever stock is bought, and the sales account surrenders the value when a sale is made. Instead of stock purchases, we may use the materials and consumables account, if the business is involved in some form of processing or service provision. Stock purchases account is best if the business doesn't carry out any processing or service provision, but just buying and selling. When a sale is made on 1st July of 2010 for $650 cash, we credit the source, which is the sales account. The debit entry is made on the destination account, which is cash, where the value ends up. Below is an illustration of the double entry. The sales account is credited with $650, while the cash account is debited with $650. We look at the bookkeeping process as being a temporary custodian of value. We get value from one account and transfer it to another account. This is the reason why we should make a credit entry before a debit entry. We first get from an account that is credited, before we give to another account that is debited. We can't give away what is not yet received. We use the right hand to get credit column, and use the left hand to give debit column. Before a value gets to its destination, it must come from somewhere. It's on this basis that we should first record the credit entry before the debit entry.
Section 9.2. Narration. A narration is a summarized explanation for a recorded transaction. It's aimed at providing some understanding to anybody who looks at the entry on the ledger account. Looking at the first illustration on the previous page, the narration on the capital account is cash invested, while the second narration on the cash account is capital invested. Although the transaction is the same, the narrations are slightly different. The aim is not to point us to the account of the corresponding entry, but to help us understand what the transaction was all about. For each of the many transactions on the cash account, we need to know where the money in the debit column came from, or what it was received for. So in this case it is capital invested. The word cash is not relevant since it's on the cash account itself. For all the monies recorded in the credit column on the cash account, we need to know what it was spent on, and not the account of the corresponding entry. On the capital account credit column, we record values invested in the business. But in what form was the investment? That is why the cash invested narration is most appropriate. Looking at the second illustration on the previous pages, we have stock purchase on the cash account, and cash purchase on the stock purchases account. They are for the same transaction but slightly different. Among the many payments on the cash account, we can tell that particular money was used to buy stock. Among the different purchases on the stock purchases account, we can tell that this was bought using cash. In the illustration on previous slides, for both the sales account and cash account, we have the same illustration of cash sale. What makes this appropriate for both is that it mentions both account names. In summary, a narration is aimed at providing some understanding about a particular transaction, to the one looking at the account. It could be a manager, a business owner, a tax inspector, or an auditor. Section 9.3. Duplication. Every transaction undertaken by a business is unique. It happens at its own time, on its own date, with its documents having their own identity numbers. Therefore, each recorded transaction should be supported by its unique source document. If a single source document supports two identical transactions, then that is an error, which might be interpreted as fraud, and it's illegal. Fraud in simple terms is cheating for a financial gain. It's on this ground that every source document is recorded only once. If the same information is extracted from the same document more than once, that is duplication, which is illegal. Even if it's at the year end, the same expense or income should not appear in more than one financial year. On a few occasions we have more than one transaction on the same source document. For example, a shoe manufacturer buys shoe polish and sugar from the same supermarket, and is given one receipt. The shoe polish is one of the consumables and it's recorded onto the materials and consumables account. The sugar is for staff refreshments, and is recorded on the refreshments account. So from the same source document, we record two different transactions, onto different accounts. This is not duplication and it's allowed since the transactions are different. However, in most cases, each document should support only one transaction. Section 9.4. Supporting documents. These are the source documents, where we extract the recorded transactions from. They include receipts, invoices, checks, bank statements, and others. We should only record transactions that have source documents. Nothing should come from our minds without a supporting document. And whatever we record, we must indicate the document, where it was extracted from. Bookkeeping and accounting records should be stored for 6 years, after the end of their financial year. So in case of a tax investigation or audit, they need to look at the documents, which support the recorded transaction.
If a supporting document is not found, then it may be interpreted as fraud, which is an imprisonable offense in some countries, if it's serious. If an expense is not supported by a source document, then it's disallowed for tax purposes. This means that it's not accepted as an expense, and this raises the profit figure, which in turn raises the tax payable. If this is discovered by tax authorities, there might be a penalty as well. It is extremely important that source documents are properly filed and referenced. We should know which documents lead to which kind of transactions, and where to find the documents to support particular types of transactions. Please note that it takes a lot of time organizing documents in order of date. If a business gets thousands of invoices per month, then it takes long hours or days to get them in this order. This arrangement is not a prerequisite for proper bookkeeping. What matters is having the documents properly referenced. Unless instructed otherwise, we should not arrange documents in date order. Documents we often find in order are the ones for income. In conclusion, we should only record transactions coming from source documents, unless otherwise.
Section 9.5. Single accounts. In the chart of accounts we identified a total of 131 accounts in the general ledger. Each of these accounts is identical, it appears only once, and none of them is duplicated. As much as possible, all the accounts that may be required for a sole trader have been identified. However, before an account is used, we must create it in the ledger. With a properly ruled page, creating an account involves writing its name or title, and underlining it, as illustrated below. The guidance here is, when a cash account is created for a particular business, all transactions involving cash are recorded on the same cash account for that financial year. We should not create more than one cash account. If we create an account for sales, all cash and credit sales are recorded on that same account for the whole financial year. For training purposes, we record as many accounts on a ledger page as it can accommodate. All we have to do is leave enough lines for each account, before we create the next account below.
In the work environment, a full page is allocated to each account. If one page is full, we allocate another page, but it's a continuation of the same particular account, with the same account number, and an opening balance from the previous page. Looking at transaction dates, we can tell which page was recorded first. There is only a single Bank 1 account, and only a single Bank 2 account. In a business scenario, Bank 1 could be the account in Barclays Bank and Bank 2 could be the account in Standard Bank. So, when we create the accounts and the ledger, Bank 1 is renamed Barclays Bank, and Bank 2 is renamed Standard Bank. For training purposes, let's try to utilize only the accounts provided in the chart of accounts. Avoid coming up with more specific accounts. Make sure all transactions fit on one of those in the chart of accounts. However, when we get to a place of work, we find unique circumstances and we are free to make sensible decisions on what other accounts to add, provided we end up with properly organized financial statements. Hi, we thank you for your cooperation through the past slides. We hope you are gaining some knowledge in the process. Please remember to note down anything important or requires clarification. You may discuss with a colleague, an accountant, or a tutor nearby. Your next option is attending our free online tutorials, where you ask any questions. Your last resort is sending an email to admin@practicalaccounts.com. If you need to have a break, just press the pause button. Otherwise, we keep firing on all cylinders. All we need is your silence and undivided attention. Thank you. Section 9.6. Account Numbering. In Chapter 3, we saw a total of 131 accounts, arranged in 30 groups, with 5 classifications. Each of the accounts is allocated a number that we should indicate at the top, after creating it.
This number helps us to arrange accounts when preparing notes to the financial statements at the year-end. As explained in Chapter 20. Not all accounts in the chart of accounts may be required by a particular business. However, if we create a telephone account 43 and a stationery account 47, we know that they are both administrative accounts. So their balances on the trial balance should be before the cash account, which is number 107, and after the sales account, that is number 1. There is more on this in the trial balance chapter. What we should not bother with is arranging accounts in the ledger according to their numbers. Accounts are created randomly according to need. If we record purchases and payments documents first, then expense accounts are created before income accounts. Their location in the ledger doesn't matter, provided we are able to assemble their balances in order, on the trial balance, as explained in Chapter 13. Section 9.7. Errors not acceptable. An error is the recording of a wrong amount, a wrong date, a wrong reference number, a wrong column, or wrong account. We have several procedures for exposing errors, which include the trial balance, bank reconciliation, cash reconciliation, creditors reconciliation, plus debtors reconciliation. However, they only expose errors involving amounts, double entry, plus the balancing process. There is no manual mechanism to expose errors and dates in the narration.
Please note that bookkeeping involves the initial part of logical thinking, and the final part, which is just copying. Logical thinking involves classifying and filing documents, identifying the transaction, generating a narration, identifying the accounts to be affected, and which columns on the particular accounts. What happens after that is just copying the amounts, the date, and the reference number, as illustrated below. This slide shows the split between logical thinking and copying. Errors to do with just copying are not acceptable. From the very beginning, we should ensure that we have no errors to do with dates, reference numbers, plus copied amounts. This is the first skill to be acquired by a good bookkeeper or accounting technician. When using software, if we record a transaction using the wrong year in the date, it will never appear in reports for the current financial year. If it's a large amount and the error is not corrected, then the reports end up misleading the users.
Section 9.8. Completion marking. This refers to indications we make by a mark, to differentiate between what is recorded and what is not yet recorded. For example, when recording purchases and payments documents, we add an internally generated reference number to each of them, just before recording. This number is recorded using a red pen for easy recognition. In case the documents on the file are not all recorded in one day, when we return the following day, we know that it's documents with red numbers that are recorded. Those without red numbers are not yet recorded. If we get sick, and somebody else has to take over, there is something to guide them over what is already recorded and what isn't yet. The income and receipts documents have internally generated numbers and we don't need to add any. What we do is tick what is recorded. So the ones without ticks are the ones not yet recorded. The wages documents normally don't have distinguishing numbers, they could be assigned numbers following on from the purchases and payments documents. When reconciling the bank statement, we tick what is confirmed as recorded correctly. So what doesn't have a tick is either not yet confirmed, or is yet to be updated on the bank account. For every task we perform, we should have a way of differentiating between what is done and what is not yet done. Section 9.9. What is recorded? What we record in bookkeeping is generally classified into 5 groups as illustrated below.
We start with opening balances, which are extracted from the notes to the balance sheet for the previous financial year, or the values of assets, liabilities, and capital at the time of starting a business. These are explained in chapters 20 and 21. We record income and non-income documents as explained in chapter 10 and 18. We record purchases and non-purchases documents as explained in chapter 11 and 17. We record wages documents as explained in Chapter 16. We record banking documents, as explained in Chapter 19. Section 9.10. Document Recording Process. Bookkeeping is a monthly or quarterly process that focuses on extracting information from documents, checking for errors, and ends with the preparation of periodic summary reports. In this section, we have a more detailed look at the document recording process, as illustrated below. You can pause to see an illustration of the document recording stages. We start with the classification of documents and filing them. We end up with a separate file for income and receipts documents, one for purchases and payments documents, one for wages documents, and one for banking documents. If the wages documents are few and it's fine with management, we can store them on the purchases and payments file. 1. Transaction identification. Recording is started by identifying the transaction on a particular document. On the income and receipts file, we should differentiate between an income paid for and income earned on credit on a sales invoice. If it's an income paid for, was it by cash, check, or electronically?
Among the documents for received money, which of them are for an income, and which of them are for a non-income? The non-incomes include debtor payment, capital invested, borrowed money, and others. A cash or paid sale is both an income and a receipt of money. On the purchases and payments file, we should differentiate between a purchase paid for and a purchase on credit on a purchases invoice. If it's a purchase paid for, was it by cash, check, electronically, or using personal money? Among the documents for paid money, which of them are for a purchase, and which of them are for a non-purchase? Non-purchase payments include borrowed money repaid, drawings, creditor payments, and others. A cash purchase is both a purchase and a payment of money. Identification is required for banking documents as well. 2. Narration. This summarized explanation is generated from the source document at the time of recording. It's done simultaneously at the time of identifying the transaction.
However, since it's not the first component of the transaction to be recorded, it should be memorized. If it's not memorized, then it's simply generated again at the recording time. 3. Accounts identification. Every value on a transaction is recorded twice in the ledger, once in a credit column and once in the debit column. If the sale had VAT, then a third entry is made on the sales VAT account. If the purchase had VAT, then a third entry is made on the purchases VAT account. So the required accounts have to be identified before the actual recording. This could be manually. If it's a credit purchase, then we have two accounts to credit, as explained in Chapter 17. If it's a credit sale, then we have two accounts to debit, as explained in Chapter 18. 4. Credit entry. On the identified account to be credited, we could start with the gross or net amount in the credit column. This is the most important, since it should be accurate to the lowest pence or cent. Next we record the narration. Finally we copy the date and reference number from the source document. 5. VAT account. If the business is VAT registered, then we have to record the VAT amounts on the sales and purchases VAT accounts. In order to facilitate the preparation of detailed VAT reports, these accounts are modified to accommodate the net and gross amounts. In addition to the amounts, we have to record the narration, date and reference numbers.
6. Debit entry. On the identified account to be debited, we could start with the gross or net amount in the debit column. Accuracy of this amount is extremely important. Next we record the narration. Finally we copy the date and reference number from the source document. These are the document recording stages, after which, we have to verify what is recorded. Section 9.11. Verifying records. To verify is to check and ensure there are no errors. Since we are human beings, we are bound to make some mistakes as we record. Therefore, some instruments have been put in place to expose some of the errors made during the recording process. We try our best, but we may not be in position to expose each and every error. By the time reports are prepared, all the obvious errors have been eliminated. Below is an illustration of the instruments we have for verifying records. Pause to see an illustration of the different verification instruments. Each of these instruments is used at different times during the recording cycle, and they are explained in the chapters ahead.
Section 9.12. Vertical accounts. Most teaching is done using the horizontal T account, which has a debit and credit side as illustrated below. However, with the coming of spreadsheets and software, it has become increasingly important that we get acquainted with vertical accounts, as illustrated below. The major difference is the duplication of the date, narrations, and document number columns on the horizontal account. The vertical account layout was developed by removing the duplicated columns and adding an extra column for balances. We have both the horizontal and vertical cash accounts illustrated above. It's the same transactions recorded on both layouts. The vertical account has a balance after each and every entry, while the horizontal account is only balanced at the end of the period. Take note of the duplication on the horizontal account, and how it's eliminated on the vertical account. We debit a vertical account by recording the amount in the debit column. We credit the account by recording in the credit column. Pause to see the advantages of vertical accounts.